Some people think you need thousands of dollars before you can even begin investing. Others wait for the perfect moment, when the market crashes, when their income's higher, or when life feels more stable. And then years pass by, and they're still waiting. But here's the truth. You could start with as little as $100. Even the world's richest investor, Warren Buffett, built his entire fortune on one principle. Because what matters most is not the size of your first investment, it's starting early enough to let time do the heavy lifting for you. Because the real magic of investing isn't about timing the market perfectly, it's about compounding. Think of compounding like planting a tree. The earlier you put the seed in the ground, the more seasons it has to grow. Even if you only water it with small amounts, over time it becomes a forest. But if you wait years before planting, you lose all that growth, and there's no way to get it back. That's why in this video, I'll walk you through a full beginner's roadmap, so you'll have a clear, step-by-step plan you can follow, starting with your very first $100. And before you get overwhelmed, here's the best part. You don't need to chase every hot stock tip or spend hours watching the market. In fact, the most successful beginner investors often do less, but in a smarter, more structured way. Now, before we get into the exact investments, let's talk about what success actually looks like. Because most beginners have a completely wrong picture in their head. Success isn't turning $100 into $10,000 in a year. That's gambling, not investing. Real investing success looks like a simple plan you can stick with for decades. It's about building a portfolio that steadily grows your wealth, while giving you peace of mind that you're not one bad trade away from losing everything. And yes, that does mean your returns will look modest at first. But here's the mindset shift. Realistic investing returns, year after year, will almost always outperform the wild swings of trying to get rich quick. A 7 to 10% annual return may not sound thrilling, but over 20 or 30 years, that's how ordinary people end up with hundreds of thousands, even millions, without ever picking a single stock hero. So where do you start? With the foundation. And the smartest first buy for a beginner isn't an individual stock. It's something called a broad equity ETF. Now, if you're new to this, an ETF, which stands for Exchange Traded Fund, is simply a basket of dozens or even hundreds of stocks. Instead of betting on one company, you own a slice of the entire market. It trades like a stock, meaning you could buy it with a single click, but inside it's highly diversified. Think of it like planting a whole garden instead of just one flower. If one flower doesn't grow well, it doesn't ruin the entire garden, because the other plants still keep thriving. A broad equity ETF, like an all-world fund or one that tracks the S&P 500, becomes your core holding. It's steady, reliable, and built for long-term growth. That's why professional investors call it a core position. It's the anchor that keeps your portfolio strong, no matter what storms come along. Now, ETFs come in different flavors, and this is where beginners sometimes get confused. Some are accumulating, and some are distributing. An accumulating ETF automatically reinvests any dividends, meaning if the companies inside it pay cash to investors, the ETF takes that money and buys you more shares behind the scenes. Your investment keeps growing and compounding without you lifting a finger. A distributing ETF, on the other hand, pays those dividends out to you in cash. That can feel nice if you want regular income, but for beginners who are just starting to build wealth, accumulating ETFs usually makes more sense. But we're just scratching the surface here, because not all ETFs are built the same way. Some hold real physical stocks inside. Others are synthetic, meaning they use financial contracts to mimic an index. And then there's something called securities lending, where an ETF lends out shares it holds to other traders for a fee. This adds a layer of complexity and sometimes extra risk that most beginners don't realize at first. In a moment, we'll dive deeper into that structure, so you can actually understand what you're buying instead of blindly trusting the label. But before we do, make sure to like and subscribe if you find the video helpful so far, because coming up, I'll also reveal when it actually makes sense to add individual stocks, why REITs can be both powerful and dangerous, and how to pick the right broker so you don't get burned by hidden fees or fractional share risks. So let's take a closer look at how ETFs are actually built, because this is something most beginners overlook, but it makes a huge difference. When you buy a physical ETF, the fund literally owns the shares inside it. If it tracks the S&P 500, that means it holds real shares of Apple, Microsoft, Amazon, and all the others in that index. Your money is tied directly to those businesses. A synthetic ETF, on the other hand, doesn't hold the stocks themselves. Instead, it uses contracts with banks, called swaps, to copy the performance of the index. On the surface, it behaves the same way, but underneath, the structure relies on a middleman. And while regulation is strong in most developed markets, this still introduces what's called counterparty risk, meaning you're trusting that the bank on the other side keeps its promises. Then there's securities lending. Some ETFs lend out the shares they hold to other traders, usually hedge funds that want to short the stock. In return, the ETF collects a fee, which can slightly boost your returns. This may sound complicated, but the important thing is that for a short time, those shares aren't sitting safely in the fund. Now, there are rules to protect investors, and in most cases, the risk is small. But it's the kind of detail that separates a blind investor from someone who truly understands what they own. And that's the shift I want you to start making. Don't just invest, understand what's inside, because that's how you build the confidence to hold through ups and downs. Now, let's zoom out for a moment. If a broad equity ETF is your core, the natural question is, when does it make sense to buy individual stocks? Here's the simple answer: only after your foundation is set. Think of your portfolio like a house. The ETF is the concrete base, broad, stable, and designed to carry weight. Individual stocks are like the decorations, the design choices, and the unique touches. You add them later, once your base is secure. And why even bother with them? Because individual stocks give you the chance to capture higher growth in specific companies you believe in. Maybe you want exposure to a fast-growing tech leader. I actually break down 3 examples of those inside this video. Or a dividend stock with decades of reliability. That's fine, as long as you're adding them as the decoration around your ETF core. But there's one more piece of the puzzle that beginners often forget: real estate. Now, before you picture buying rental properties and fixing leaky toilets, let me introduce you to REITs. REIT stands for Real Estate Investment Trust. These are companies that own and manage real estate. Everything from apartment complexes and office buildings to warehouses and even data centers. By law, they're required to pay out most of their profits to shareholders, which means if you own a REIT, you get regular income, often in the form of dividends. And dividends are simply cash payments you get from your investments, whether that's from individual companies, ETFs, or even REITs. It's like your garden of investments rewarding you with fruit, vegetables, or herbs, depending on what you planted. That sounds perfect, right? Exposure to real estate, steady cash flow, and no landlord headaches. But here's the catch: REITs are sensitive to interest rates. When rates go up, REIT stock prices often fall, even if the properties themselves keep earning rent. That could be stressful if you don't understand why it's happening. And that's why, for beginners, REIT ETFs can be a safer approach. Instead of betting on one landlord company, you spread your risk across dozens of them. You still get income, but with more stability. Now, you might be thinking, okay, ETFs, stocks, REITs, this is starting to sound like a lot. How do I actually manage all this? Don't worry. In a moment, I'll show you exactly how to keep it simple with something called a core satellite setup. It's the structure professional investors use, and it's far easier than it sounds. But before we could build that, there's one step you cannot skip: choosing the right broker. Because it doesn't matter how smart your investments are. If your broker's unsafe, overpriced, or makes investing confusing, your plan can fall apart before it even begins. So let's talk about brokers, the platform where you actually buy and sell your investments. For beginners, the most important thing is safety. Always start by checking if the broker is regulated in your country. That means it's overseen by a financial authority, required to keep your money separate from its own business funds, and subject to strict rules. If a broker isn't regulated, it doesn't matter how low the fees are. Your money is at risk. The second factor is costs. Some brokers advertise commission-free trading, but still make money in sneaky ways, through spreads, hidden charges, or currency conversion fees. That's why you should always look at the total cost of buying and holding investments, not just the headline. The third factor is ease of use. If the platform feels confusing or full of buttons you don't understand, it's easy to make mistakes. A good broker should make it simple to deposit, buy, hold, and eventually withdraw your money. And here's where fractional shares come in. Fractional shares sound amazing for beginners, and they can be. Instead of needing hundreds of dollars to buy one share of Apple or Tesla, you could just buy a fraction of that share. It lets you invest small amounts in big companies, even with only $10 or $50. But here's what most people don't realize. When you buy a fractional share, you're not always the legal owner of that exact piece of the company. In many cases, the broker's holding the full share on their books, and then they're essentially splitting it up for customers. That means you don't get voting rights at shareholder meetings. It also means that if the broker were to go bankrupt, fractional shares may not be treated the same as full shares in a recovery process. So while fractional shares are a great way to get started, it's smart not to build your entire portfolio out of them. Use them as a tool, but understand their limits. Now, once you've got your broker and you're ready to buy, you'll see something that confuses almost every beginner: market orders versus limit orders. A market order is the simplest. It just buys or sells at the best available price right now. It's instant, and for small amounts, it's usually fine. But if you're investing larger sums, or the stock moves up and down a lot, you might not like the exact price you get. That's where a limit order comes in. A limit order lets you set the maximum price you're willing to pay, or the minimum you're willing to accept when selling. It gives you control, but it may take longer to fill. For beginners, market orders are usually the easiest way to start, but learning limit orders gives you more precision once you're comfortable. Okay, now that you know how to actually place trades, let's build your portfolio. The simplest, most effective structure is something called core satellite. Here's how it works. Your core is that broad equity ETF we talked about earlier. This should be the largest part of your portfolio because it gives you instant diversification across hundreds of companies, and it grows steadily over time. Think of it as the engine. Around that, you can add satellites, maybe a dividend ETF for income, maybe a sector ETF if you want to target technology, healthcare, or clean energy, or maybe a couple of individual stocks you truly believe in. The satellites are smaller positions. They give your portfolio some personality, but they're not carrying all the weight. This way, even if your satellite picks don't do well, your core keeps driving your wealth forward. And if you pick some winners, the satellite boosts your returns without putting your whole plan at risk. Now, you might be wondering, how much should go into the core and how much into the satellites? There's not one perfect answer, because it depends on your risk tolerance. But a simple rule of thumb is that beginners should keep the majority, often 70, 80, even 90% in their core ETF. The satellites are just the extras, not the foundation. And you don't need to own 20 different ETFs or dozens of stocks. Over-diversifying just creates a mess. A core ETF plus a handful of carefully chosen satellites is more than enough. Alright, now let's talk about the traps that beginners fall into all the time, like chasing hot stocks on social media, over-diversifying, paying hidden fees, or over-trading out of boredom, because these mistakes can destroy years of progress. The first is FOMO, the fear of missing out. You see a stock exploding on social media, and it feels like if you don't buy it now, you'll miss the chance of a lifetime. But the truth is, by the time everyone's talking about it, most of the gains are already behind you. Chasing hype usually ends with buying high and selling low, which is kind of not the point of investing. The second trap is over-diversifying. Some beginners think safety means owning a little bit of everything, but spreading yourself across too many ETFs and dozens of tiny stock positions can actually water down your returns and make it impossible to keep track of what you own. It should be concentrated enough to matter and diversified enough to be safe. The third trap is fees. Even small percentage fees eat away at your returns over decades. High fee funds, hidden broker charges, or constantly trading in and out all cut into your compounding. Keep costs low, and your future self will thank you. And the fourth trap is over-trading. Beginners often feel like they should always be doing something, but most successful investors make fewer moves, not more. Buying, holding, and letting compounding work is usually far more powerful than trying to time every market swing. Which brings us to the big question. What do you do when the market crashes? Here's the uncomfortable reality. It will happen. Crashes are a normal part of investing, and when they come, they don't feel good. Your portfolio might be down 20, 30, or even 40%. The headlines will scream. Everyone around you will be panicking. But the worst thing you could do is sell everything and lock in the loss. Historically, markets have always recovered, and often much faster than people expect. The investors who sell in fear often miss the rebound, and that's how decades of growth are lost in a single mistake. So instead, the best approach is to stay the course and keep holding your core ETF. If you're regularly investing, keep dollar cost averaging, meaning you invest the same amount of money every month, regardless of the market price. In a crash, that actually works in your favor because you're buying more shares at lower prices. And if you have cash saved on the side, a crash can be the best time to deploy it carefully. That's when long-term investors build positions that later look like genius moves. Now, here's the secret most people don't tell you. Once you've built your portfolio, it doesn't take constant management. In fact, too much tinkering usually hurts more than it helps. The smart approach is light maintenance. Every once in a while, check if your portfolio's drifted too far from your plan. For example, if your core ETF was supposed to be 80% of your portfolio, but it dropped to 70% because your satellites grew faster, you can rebalance by adding more to the core. Just simple, occasional adjustments, not constant worrying. And that's really the beauty of investing the right way. Once the structure's in place, you don't need to spend every day watching the market. You can get on with your life, knowing your money's working for you in the background. If you follow this path, you'll be far ahead of most beginners who waste years chasing hype stocks or waiting on the sidelines. And here's the exciting part. Once your beginner foundation's set, there's some upgrades you can explore that will pay you every single month. So click the video on your screen, and I'll see you there.